Hey, Rick, thanks so much for joining me on the podcast today.
My pleasure, Ben.
Yeah, fantastic. Hey, before we get into the meaty stuff, I'd love to sort of learn about what you get up to when you're not working or talking with other accountants.
That's a good question. People who know me well probably don't think that there's anything else I do other than work. But my two life loves really are touring in the Australian outback. And I've done quite a lot of that, a lot of desert crossings and camping and so on. I just find it not only relaxing, but it's really quite cathartic. It's just gives you a sense of just how wonderful this world is. But the other thing I like to do, my favorite winter sport is skiing in Canada. And apart from the fact that it's been interrupted with COVID the last couple of years, I like to spend 2 or 3 months over there with friends in British Columbia and make a few turns and have a few beers and tell a few lies.
Fantastic. And I've never been to Canada, so I have no idea what that's like for skiing. But where's your favourite place to go to in outback Australia?
Oh, probably everywhere. I've done the Central Desert and the Canning Stock route and all around Queensland, Western Australia, and most of New South Wales. So it's the whole country is just magnificent. Once you get out of the city, it's just terrific. So many people think that the desert is just boring, but literally every couple of kilometers there's something different, and it might be flat and look as though nothing changes, but the colors change, the sky changes. It's incredible, and I thoroughly enjoy it. But haven't done much in the last couple of years, unfortunately, because of weather and border blockages. And so anyway, there's still some future.
Yeah, I enjoyed seeing your pictures on Facebook when you were traveling, but that'll happen again soon.
It will.
Very good. All righty. Well, would you be able to run us through what your background in the accounting industry has been? I think let's start at a bit of a high level, like your key milestones, and then I'd love to talk about each of those in a bit of detail.
Well, that is quite a challenging question. I could be here for the next 2 days, but I did an agricultural economics degree, so I had absolutely no intention whatsoever of being an accountant. My father was an accountant in Sydney in a firm that subsequently became Deloitte's, but he was a serious accountant, and he sort of figured that I might do the same thing. But we had a farm, and I spent a lot of time on the farm and really got interested in agriculture. And when I look back on the training for the career I had, eventually had in accounting, what I learned on the farm was far more valuable than what I learned when I did accounting courses at university. But anyway, after I finished university, I had a scholarship with the Commonwealth government, the Bureau of Agricultural Economics, and I ended up had to work in Canberra. And while in Canberra, I and 2 other friends started a business down there selling sheepskins of all things. And it turned out to be really quite successful. We each put $300 in, and in the first year we turned over $1 million. Now, back in the late 60s, early 70s, that was a serious amount of money.
That is in a year.
Yeah, in 1 year. We had no concept of how you should run a business. We didn't understand accounting. We didn't understand anything. But we had a couple of wonderful mentors, Ben, and once again, you learn from these things. The guy who supplied us with the sheepskins was a German tanner in Melbourne. And we said, could we buy, a whole bunch of sheepskins because we want to sell them? And he said, I will only sell you skins if you pay for them. Well, we had bugger all money to actually pay for it. And we explained that. And he said, I will give you 7 days credit. So I'll sell you 7 days worth of skins. You pay me, and then I'll send another 7 days. And so I learned this lesson that you needed to tie your turnover and your inventory together in some coherent manner so that you could fund your growth from internal sources, which is effectively what we did. And in order to pay him and cover our other costs, we had to have a margin, a profit margin or gross margin that, allowed us to do that. Now, when I went to our accountant, I said, we've started this business. Is there anything that we need to do? All he could say to us was just keep all your receipts and bring them in at the end of the year. And I'm thinking, well, I was hoping he might tell me how I might be able to run my business a little bit better.
Yep.
Now, I had learnt the concept of gross margins when I did a farm management course at university, but the accountant didn't tell me anything about this. So anyway, that business was pretty successful, and it got me interested in business generally. And as soon as I got out of the this requirement of working with the government, I decided to go to business school, and that's where I did a whole bunch of accounting courses and so on, and got to be a qualified accountant. But while I was there, my mentor and the professor, the head of the department, was a guy named Jeff Meredith, who was a specialist in small business and small business management and accounting for small businesses. And he talked me into pursuing an academic career. And he said, there is so much that accountants can do to help people run a better business and through that create a better life, that people like you could make a dramatic difference. In other words, he gave me a purpose in doing what I was doing. And so I ended up getting a job in Lismore at what was then the Northern Rivers College of Advanced Education, is now the Southern Cross University.
Yep.
And I taught there for about 8 or 9 years. And then I got disillusioned with academia and so on, but I've been teaching entrepreneurship and business management and management accounting and management decision theory and all these kind of subjects. And I thought, well, there's not much I don't know about running a business. I'll go into public practice. So I bought into a small public practice, just 2 people.
Yep.
And we rapidly grew that from around about 170,000 to 350,000 in about 18 months, just by focusing on, business advisory type of services. But that's when I learned another lesson, and that is that there's a big difference between teaching in a classroom or writing a book about business management and actually working at the coalface, actually talking to small business people who have limited resources and limited sort of ability to think conceptually about their business. And it's really tough. And after that, a larger firm in Lismore, Rutherford's, actually approached us and said, would you like to merge your practice with ours? And we got a bigger client base. And so I ended up as a partner with Rutherford's. Now, the interesting thing from a point of view of practice development there was that I came in as a partner. I didn't come in as a sort of lower level person and then be forced into doing bookkeeping or BAS returns, tax work or audits and so on. I have never done a tax return in my life, so
I think that's incredible.
I might be the only accountant who's never done a tax return. Someone else has always done them for me.
Yep.
But Rutherford's was a phenomenally interesting practice. It was a fantastic place to to be working. It had half a dozen partners and about 20 staff at that time, which was not a good balance. But
yeah, I was going to say.
It was not a good balance at all. It just emerged like that. But what had happened, Ben, was that when you have that sort of leverage of partners and team members, what that tells you is that the partners are doing an awful lot of low-level work.
Yep.
Now, that was obvious from when you looked at the revenue in the firm. Rutherford's was actually formed after the Second World War. And in 40 years, it had grown from a startup to about $1 million in fees, a few bucks short of $1 million bucks in fees.
Yep.
Then from 1987 to around 1993, about 4 or 5 years, it went from $1 million to about $4 million.
Yeah,
now, how did it do that? Well, it increased its leverage. One of the partners who was there, a good friend of mine, his name's Jim McCurley, and some people listening to this would know Jim. But Jim drove the partnership to hire a bunch of young, talented people straight out of school, sign them up at the local university to do an accounting degree. And by the time we got to the 1990, because I joined Rutherford's in 1987 or thereabouts. Not thereabouts, in 1987 I joined.
Yep.
In that 3 or 4 years, those people really hit their tracks, and we had that manager level within the firm. That released the partners from doing a lot of that low-level grunt work, freed up the partners to go and bring more quality work into the firm. And that, together with a whole bunch of other changes that we made within the practice in terms of positioning ourselves as the logical firm for businesses to go to, made a dramatic, absolutely dramatic difference. And so the lesson that I learned from that, Ben, is you've got to have leverage if you want to have profitability. And the only way to get profitability is to create value for your customers. And the only way you can create value for your customers is to A, have the right customers, and B, understand how to position the value that you can deliver to them, and then you've got to deliver it.
Yeah.
And we had all of those pieces in place. But if we hadn't hired those youngsters back in the mid 80s, this is before I joined them, but if they hadn't been hired, that would never have happened.
Yep.
You've always got to look at the long game. Unfortunately, so many practitioners tend to look at the short game. What can my billable hours be today or this week, rather than thinking about that when I'm focused on this week's billable hours, I'm not thinking about next year's growth.
Yep, and I saw that really blatantly when I was in one of the big four firms. What normally happened is the big four would get the top 1% of uni graduates because they do their marketing campaigns and all their interviews, and they'd sort of handpick the ones they wanted to work with. And then over the next 2 to 3 years, those people would get their chartered accountants certificate. And what normally happened after that point is they didn't like the big four, so they went in and worked in commercial. And I was kind of confused of why so many people left. It was almost that's what you did. You got your CA with them and then left. But that's going to be like, in terms of the cost for the business of those people leaving, it would be insane, especially when most of them would be really switched on. So very cool. And were there any other sort of really high-level strategies that stood out at Rutherford's that made the biggest impact?
There were a few things that we did, Ben. One was Rutherford's also moved from a fairly typical practice on the inner city block that was upstairs. It was timber-lined walls. It smelled like erasers and ledger cards and so on. And they moved into a magnificent landmark in Lismore with lots of glass, stainless steel, brand new office. It really looked the part.
Yeah.
Now, a lot of our, I'll say the dairy farmer type clients looked at that building and said, we're not paying for this. And we said, that's a great idea. You go somewhere else. But people who were coming into town with money to invest in the Northern Rivers, and the Northern Rivers was really growing quite rapidly at that point, looked at that building and said, obviously, this is the type of accounting practice we need to be working with. So we attracted, because of, some people call these things artifacts. The artifact that we had was consistent with the business model that we were creating. And we gave all of our team members great facilities to work in, comfortable chairs. We gave them good computers with great screens and plenty of light, and everything was designed to make their life easier, better, enable them to be more productive and so on. And then we did a lot of internal things as well to make the work that they did A, meaningful, and B, easy for them to get on and do. We had a great mentoring program. We gave them lots of access to clients, and they did a lot of client-facing work. We would take them out on client visits and so on. We were obviously concerned with productivity, but if there wasn't any work for them to do, we would take them out with us, and they get an opportunity to meet a client and see the business of accounting done in the flesh, so to speak.
And I think there's some great examples of creating a great culture, especially for team members. And I think that's really relevant for where we are at the moment, with a lot of people struggling to hire the right people or retain the right people. Awesome. And earlier we spoke about capacity, and one thing that you mentioned is that Rutherford's had that, or aimed to have that, surplus capacity. Could you tell us a bit more about that?
Well, I think a lot of accountants tend to think, and maybe they're not the only people in business who do this, but they tend to want to balance their capacity with the demand. And that is just the wrong thing to do. It's not a question of saying, if we have this, they will come. But that's the way it tends to work out. If you have some surplus capacity, you have the ability to handle pretty well any situation that's likely to arise with a client. When they need something urgently, you're able to deal with them. And that's what sort of builds value. But what we realized was that when you look at the interfirm comparison data, we realized that we needed to get a leverage ratio of about 10 to 1.
Wow.
So, 10 team members to one partner. In order to get to premium profit levels. Now, there are different firms that might have lower ratios than that, but those type of firms will only achieve very high levels of net profit per partner if they are doing very high level work. If you've got 10 to 1, you're going to be doing pretty well. And if you've got more than 10 to 1, you can be doing very well. In fact, the most profitable practices that I have seen have had ratios in the order of 40 to 1.
Wow.
And one owner, many managers, extraordinarily well compensated, and each of those business units will have 8 to 10 people or 6 to 8 people, and then you've got your administrative support group under there. But they're the dynamics of this business, and I think we will with the way technology's going, that is going to become more and more possible.
Yeah. Yep. That's a good point. All righty. So what happened after Rutherford's?
Well, after Rutherford's, I went to a program that Paul Dunn was running down in the Blue Mountains, and I took a client down there because it was a marketing boot camp.
Mm-hmm.
And I had a client who I'd done what I thought was some pretty good work on sort of strategic planning and so on, but the piece that was missing was the marketing piece.
Mm.
And so I went down there with this client, and it was one of these deals where two people come for a single price, and I convinced the client that he could pay for that. And it was, well, I said, you pay for it and I'll write that it was, I think it cost us about $4,500 or something for to go to this program. It was just the program cost.
Yeah, wow.
Anyway, on the last day, and this was a 3 or 4 day, it was a 3-day program, I think. And the last day, Paul Dunn got on stage and said, our goal is to change the face of small business on the planet.
Mm.
And I thought, well, that's a good goal, but he was talking to about 120 small business people in this room. And as far as I know, I was the only accountant, but I thought, if he's only going to be doing this to 120 people at a time, it's going to take an awful long time to change the face of business. But at the break, Paul and I were looking into the Gross Valley from Fairmont Resort, and I mentioned to him that if he had 120 clients in that, accountants in that room, each of them on average would have about 250 business clients. And you may well be able to change the face of small business on the planet. And one thing led to the next, and then we came up with this idea of running an accountant's boot camp.
Yep.
And I was still a partner in Rutherford's at the time, but the accountant's boot camp was started, and ultimately Paul's other partner at the time decided he didn't want to be part of that. Paul and I got together. I went to the US to start the business in the US. We'd run about 5 or 6 boot camps in Australia at that time.
Yep.
And a couple of US people had come over to it and had taken a great report back home. So I went over to the US and to start it over there, but I stayed there for 23 years.
Yeah, wow.
And we started the accountants boot camp in Australia and the US and the UK and Canada, and 10,000 firms, and it was, the rest is history, so to speak.
Yep, there you go. And I was in my first few years of my life in the 90s, but I have definitely heard of the accountants boot camp from other accountants who I've met along the journey. And I've got this kind of picture in my head of what it might have been. But would you be able to sort of describe what that weekend or that few days looked like, and the types of conversations that you had?
Well, it was an amazing experience. I mean, it exceeded my expectations. But Paul and I, he came down to, I had an apartment down at Lennox Head, and he came down to Lennox, and we had, over breakfast, we said, what will we put in this program? And it was very much built around what could accountants do for their clients. And Paul was, he was an expert in customer service strategies and phone technologies and a whole lot of stuff that happens within business. Obviously, marketing, copywriting, these sorts of things. And I had a pretty good handle on at least what I thought, I ran a thing called the 10 Myths of Public Practice.
Yep.
And I built some software that was pretty useful. It was called the Business Performance Review and Planning System, which was so advanced. It's not, when I look now at what's around, I mean, it was so far ahead of the rest of the pack, it's not funny.
Yeah, wow.
And I had done some pretty good stuff on strategy and so on. So anyway, we put this thing together, this program together, and it was an outrageous success, the first one that we did. But we really didn't know where we would go from there, and it just evolved. But essentially the message we had was accountants can create so much more value for their selected clients. It goes beyond accounting. It's really a holistic kind of approach, and we effectively gave them permission to implement a different business model. And it was a business model built on inclusion of their team members, a focus on their customers, the changing their whole management philosophy from a top down to a bottom up type of philosophy. And over time we developed a whole bunch of tools, the analytical tools, marketing tools, selling tools, one thing led to the next. So we had this very substantial toolkit and knowledge base, and one thing led to the next, and we ran literally thousands of firms and participated in the program.
Yeah, fantastic. And so and I guess is that where the sort of conversations were happening around, hey, it's not just about this compliance thing, and that maybe started when you had your experience running the sheepskin business, but is that the sort of message, to have that broader conversation with your top clients?
Absolutely. It was not just the top client. The whole, where we were really focused on was you need to take much more care in selecting your clients. And we had a definition: the optimal client was someone in respect of whom we can create value, who will recognize the contribution we make to creating that value, and would therefore be willing to pay a reasonable, or share a reasonable part of it. And so client selection was important. Now, it's all very well to have a discerning sort of client selection criteria, but you have to have a delivery protocol that's going to accommodate that client's needs, and you need to have the people who are going to be able to do it, and you need to give them the freedom to be client facing and to be thinking about the client the whole time. And so we really tried to take people out of the back office and put them in front of the client mentally, and to be thinking about what can we be doing to help this client. Now, we did all the normal things. We looked at productivity. Back in those days, we were saying, timesheets can be used for pricing if you wish, but we were talking value pricing. Back when we first met Ron Baker, we started talking about value pricing. But we didn't say, oh, you got to trash your timesheets or you've got to do. Although, I think Paul is in the trash timesheet sort of bandwagon at the moment. I'm not completely in that bandwagon, because I think there can be room for them if you want to keep them. But essentially, it was a different business model. That was what we were trying to do. Just be more focused on the client, more focused on your team, give them opportunities. People like Dan Pink pretty well summarized in his book Drive, summarized our philosophy, and that is, you've got to have good people, then you need to give them opportunities, you need to give them autonomy, which is just another way of saying trust them to get on with the job. And then you have to give them purpose. You have to give them a reason to come to work. And so, we developed things like a team member monthly reporting kind of tool, where we encourage people to say, what went right this month, what didn't go right this month, and to have open communication within the these are things that are so mind-blowingly simple to do. And yet the average practitioner who says, oh, it's so hard to get talent nowadays, when they say that, that they're running a command and control organization. They're focused on how the billable hours and, just work hard and get the job done and out the door. You don't need to know about this. We don't want you too close to the client because you might leave and take your client with you and so on. And they wonder why people don't want to work there.
Yeah. Yep. And I guess we're pretty forward in popping our team members in front of clients, even kind of, I wouldn't sort of take them straight out of uni and do that, not at least leading the conversation. But I think that there'd be a lot of fear about, hey, what if they say the wrong thing? What if they make a mistake? Like, what's your sort of comment to that?
Look, everybody makes mistakes. You'll never, if you're not making a mistake, Ben, you're not learning.
Yep.
And so cool. I think if you have a youngster straight out of university, if they're smart, you say, look, if you don't feel comfortable in saying something, don't say it, but say it to me afterwards.
Yeah.
And we will talk it through. But one of the things that we did do, we ran a thing called an advanced financial management program. And frankly, it wasn't that advanced, but it was designed for business people to take them through how to read and understand financial statements, how to do budgets, cash flows, the difference in cash and profit, and how to work with your accountant, and introduction to business strategy. Pretty straightforward stuff. All of our, because at this stage we had about 50 people working for us now.
Yeah,
so
geez.
the firm was a lot bigger. But what we did was say, look, instead of me doing that program, because I was the one who was originally presenting it, it was just an extension of the work I did when I was at the university. We said to these people, you do it.
Yeah.
Now, here's a really interesting thing, Ben. When you give a young person a responsibility to get in front of a group, you immediately enhance their sense of self-worth. You send a message to your client that there's some real depth in the bench in this firm, some real depth. These are very talented young people, and I'd be quite happy working directly with them, which means you can start to delegate work.
Yes.
But perhaps most important, you say to these people, I trust you.
Yep.
And if you say to someone, I trust you, they will trust you back. And when you get trust going both ways, you get candor, and people will be happy to share their thoughts in a candid kind of a way. And you build this camaraderie, this feeling that we are valued members of a team. Now, that's the sort of stuff that gets people to jump out of bed in the morning and say, thank God it's Monday, I'm going to work.
Yep.
And these are the people who refer the practice to their friends and say, this is a great place to work. Now, if you've got people going to university, they're bumping into potential candidate employees.
Yep, for sure.
And their employees say, what's it like to work at ABC and Company or whatever, or Inspire? So it's phenomenal. I love it. Yeah. I get to do all different things. I get to meet different clients. I feel that I'm learning stuff every day. Those sort of firms don't have any difficulty hiring talent.
One of the comments we get after someone's been there for maybe sort of a year or two is that they feel like Inspire years are dog years, like it's sort of 7 years in one.
Yeah.
The amount of
Well,
stuff we go through.
there you go.
Yeah. Yep. So really, really cool. So you had basically your junior to sort of mid-level people teaching that advanced financial management program.
Yeah, they were teaching it, and they do a hell of a lot of preparation, and they'd be as nervous as all hell.
Yeah.
But the minute they did it, that's when you get that buzz, that adrenaline release, that when you're doing that thing, and you get this dopamine sort of hit when it's all over, and people say that was fantastic.
Yep.
I know. So, and the other interesting thing, Ben, we used to charge for that.
Yep.
But we used to say to our clients, if you would like to bring a friend or a colleague or someone who you might know, who you think would be interested in this stuff, bring them along. So we got to talk in front of a group of prospects for a whole day.
Yeah, which I bet you the conversion rate off the back of the workshops would have been
exactly.
Extreme.
Even if we didn't sign them up, we would become the firm of first resort. If their firm pissed them off, and that was always our position. We don't want to take you away from this firm, but what we would like you to think that we are the first alternative choice.
Yep. Yeah. Cool. That's a great way to think about it. How good. I'm writing down plenty of notes myself too.
It was great. I really loved my time in practice, but I probably loved my time working with Paul even more. I mean, the boot camp was fantastic because it profoundly impacted so many people, both directly and indirectly.
Yep.
And Paul is even still doing it. I mean, I take my hat off to him. I don't know where he gets the energy, but
yep. And maybe sort of while we're chatting about your time with him, what were some of the key ingredients, or having a look at the top performing firms that implemented what you did? What was the common thread in those? So if you think maybe the sort of top 5 to 10 firms that you remember working with, what did they all have in common?
Well, the first thing I'd say is that I wouldn't say that all of them, if there was one thing that they had in common, was a willingness to change and to let go of a command and control management style, to empower and respect their people, to be more discerning with their selection of client, the people that they would be seeking to work with.
Yep.
That they would be the common threads. When bearing in mind at the time, a lot of the stuff we talked about then I mentioned this term earlier on, the long game, that you don't achieve greatness in a business overnight. You really have to work at it. And for some of these firms, the boot camp was a catalyst for a lot of partnerships splitting up.
Okay. Yep.
Because they didn't share a vision.
And they identified that.
Yeah.
Yep.
They a lot of partnerships split up because they didn't share a vision. That led to some other partnerships forming, but more often than not, it was one guy going out with a bunch of clients and building a firm, and then bringing people in who shared his or her vision.
Yep.
And so, not so long ago, I heard from a guy who was telling me that he had this exactly happened to him. He had over 50 people now working with him. He's not doing much work anymore. He's just a chairman, and the practice is humming along. But that's what I would say is the common thread. This realizing that you've got to, in the profession nowadays, with the type of people who are succeeding in it, you've got to give them room to be individuals. They reject the command and control style. They want to be client focused. They want facilities to, you know, the latest tools and technology, etc.
Yep.
Allowing people to make mistakes. You know, this whole idea, you only learn if you've made a mistake.
Yep. Yeah. Sometimes they're expensive lessons to learn, but anyway,
yeah.
It's an investment, maybe. That's the way to look at it.
Yeah, it is.
And when you say vision, I think many people have different perspectives as what that word means, but what did you see as what's important for an accounting firm or the owner's vision? What's the ingredients you need in that?
Well, you know, that is a good question. There's a lot of bullshit floating around vision, probably even from me.
Bit of fluff.
Michael Gerber was a guy who influenced my definition of vision. And to me, we look at vision, mission, and values. When I think vision, I think about what do I want this firm to look like when it's finally done.
Yep.
That's how Michael described it, or my recollection. And I remember this is one of the things I used to do with my clients. I'd say to them, I want you to write a letter to someone that you know and respect from a perspective of 5 to 10 years down the track, explaining to them what you are now doing in your business. Yeah. And in that, I want you to talk about how you feel about your business, who you have working in the business, what type of clients you're doing, working with, what you are doing for those clients, what value they're getting from it. In other words, what you feel you have accomplished. Yep. Okay. Now, when they write that letter and sit down and you share it with partners, for example, in a multi-partner firm, or if I'm coaching somebody, I would have them do that. Yeah. And we would talk about what do you need to start working on now in order to get there. And if you've got multiple partners and they each have a different story to tell, you've got a problem before you even start, because that's their vision. Yep. You know, that's what they want to create. Now, I then define a mission as being your governing commercial purpose. And by that I mean, what are you going to do in the next 12 months or the next 12 months to 3 years, which you will be able to sell to people who will value what you're doing. That's your commercial vision. And that may change. Yeah. And maybe even your vision will change over time as you start to experience different things and different socio-economic, political, or whatever might play out. But then the values, that should never change. Your values should never change, you know. Now we hear a lot about the values of integrity and hard work and so on, but you got to dig deep and say, what are the guiding principles for my life? And one of the things I recommend to people now, and I wish that I had this resource when I was 20 years of age, is to read, and when I say read, I mean study Stephen Covey's 7 Habits of Highly Effective People. Yep. Because, Ben, that is a blueprint for personal success. Yes. You know, it's a really important document. I mean, the way I see it is that everybody who wants to achieve success must realize they have to take personal responsibility for it. So that's his habit number 1, be proactive. You got to take personal responsibility and work with the things that you can influence, that you can change, and forget about the things that fall outside of that. You then need to have a vision. You need to figure out where you want to go. Yep. And then you need to prioritize your action. In other words, your behavior, the time management or personal life management needs to be focused on accomplishing that vision. Now, Covey says when you achieve all those three habits, you become independent. You're now controlling your own destiny.
Yep.
And then the next three habits are seeking first to understand before being understood. In other words, see the world through the lens of your customers, see the world through the lens of your team members, and so on. Then you need to find win-win situations with everything. You know, business is not, successful business doesn't have to be a zero-sum game. You've got to be looking for how do you win and how do they. This is not just Covey. I mean, this is fundamental stuff. Universal laws of fair exchange. And, And then the sixth habit is synergy, diversity. Now, in a typical top-down management style, the guy at the top thinks he or she knows everything. They don't look for synergy. They look for someone to control. But synergy comes from diversity. Different people, different experiences, and so on. Put two people with the same experience in the room, one of them shouldn't be there. You know, so, and then finally, the seventh habit is, he talks about sharpening the saw, but it's focusing on the body, mind, the heart, and he would say spirit, I would say purpose, body, mind, heart, and purpose. Now, be fit, be healthy, meditate, you know, attend to your physical well-being, your mind, read like mad. Readers are leaders and leaders are readers. You know, that's people who, if you ask the question, one common thing, that one common thing is a lot of these people are voracious readers. And you know, they why try and learn a whole bunch of life lessons when you can learn from somebody else's life lessons? You know, it just seems to me to make sense. But then the heart, you know, make sure that you develop your relationships with your family, with your children, but also with your team members and your clients. You know, it doesn't mean you have to be, you know, socializing with all of your clients, but if you don't respect them, if you don't like them, then you shouldn't be working with them. And we used to I had 11 client selection criteria, and one of them was that life is too short to spend time working with turds. And so many people put up with clients who just don't want to be there. And in part because they don't see the world as, or they see the world as a zero-sum game. In other words, I want to get as much as I can from this practice and give them as little as possible back. They treat your team members badly. They whinge, they complain, they don't like paying their bills, and you know, they're both financial and emotional bullies. So those seven habits, I mean, some of the stuff that I'm writing at the moment is this whole practice development thing is built around those seven characteristics of building a great firm. Take responsibility for it, know where you want to go, allocate your time and resources to accomplish that objective. Then go and look at, how do I create win-win situations for clients? I need to understand where they're coming from through their eyes, establish empathy. That's the only way you can sell, but most importantly, it's the only way you can understand what people really want. And then bring a team together and match that with a resource set that will enable you to create value for those team members and be fit, healthy, and what a great life. Doing what you love with other people doing the same.
Yeah, cool. Hey, one of the other topics I wanted to run through with you today is around this thing of advisory for accounting firms. So, ever since I started Inspire, going to seminars and courses and coaching, there's this big push to sort of step away from compliance into advisory, and there's a million and one ways it seems that you could do it, or that sort of shared that you can do it. Now, it's interesting that you've never done a tax return before in your public practice life or life in general, apart from your own. I'm assuming in terms of getting them done. But what's your thought processes on how accounting firms should implement advisory in their businesses?
Well, this really opens Pandora's box. When I originally started working with Paul, and certainly the vision that I had with when I went into Rutherford's was we would create an advisory practice, and I mentioned before what that means to me. It's a profit improvement, a profit enhancement business where we proactively work with selected clients to improve the profitability and therefore the value of their business, to give them greater lifestyle choices and so on. In other words, to help them optimize that, to fill in the knowledge gap for them, because these people are technically good at what they do, but they are not necessarily technically good at building a business around what they do. So that was the idea. Now, a lot of accountants already provide advisory services in the sense that somebody comes to them and says, well, what sort of accounting system should I use? Oh, well, you've got a choice, Xero, QuickBooks, or whatever. So we can help you implement that and so on. Who do I hire to do my booking? Well, we can help you get somebody there. How can I minimize my taxes and so on? Well, we can do this, this, and this. We probably set up a superannuation, self-managed superannuation fund for you. And so all of that kind is advisory type work. It goes over and above just doing a tax return or doing a review and compilation of their financials. But what we were talking about was going beyond that, like saying those things are a given. That's just part of what we do. What we want to do is work with a small selection of our clients who are willing and ready to take their business to, and I hate to use this phrase, but to the next level. Okay. Now, in the last few years, what has happened structurally in the accounting profession is cloud-based accounting solutions have made it possible to get very close to real-time accounting data, which was never really possible before with the client service architecture that used to be used in the preparation of financials before. You know, the old days of MyOb or QuickBooks and so on. It took you a month or so to get the accounts on a floppy disk. You're not old enough to know what a floppy disk is.
Oh, I'm just
it's a bad back or something. But,
I do remember them.
But anyway, by the time you got a set of financials out, oftentimes it was 9 months down the track. I mean, the horse had already bolted by then. And so there wasn't much point. The second thing is, Ben, back in those days, it took quite a lot of time to collect this stuff, to go through it, to put through correcting journal entries, to tidy everything up, to prepare a tax return quasi-manually, to file it and so on. There wasn't any time left in the day to be thinking about running a better business. Now, move forward a bit with the cloud, all of a sudden, in real time, an accountant can be pretty well, apart from stock takes, but an accountant can pretty well see, what a client's business is doing. And so then all of a sudden this group of people come along that I call the tool makers, and they suck these numbers out of the general ledger that is provided by Xero or QBO or Sage or your accounting system of choice, and they produce these fancy what they call KPIs, key performance indicators. And then they put the word strategy in front of it, which immediately adds $100 a minute or something to the value of the. So it's just adding the word strategy or strategic. Or I saw the other day an ad from one business that's now doing strategic budgeting. What the fuck's that? So anyway. So this thing is now, so they're now doing strategic conversations. Now, one of the reasons we ran that account, what do I call it? The Advanced Financial Management Program. One of the reasons we ran that, because we realized that our clients did not understand concepts like gross margin, overheads, fixed costs, variable costs. They did not understand these things. So it's no point having a whole bunch of dashboards that might talk about these things if people don't know what they're looking at. And so the strategic conversations that you would be having with the client with their monthly meeting, the first one, the client say, wow, that's really interesting. But they probably won't say, I don't know what a gross margin is, but it's interesting. And so moving from that point to say your break-even point is this, your margin of safety is that. What that means is that if your sales drop down to this level, you will be at break-even and so on. If you were to change your prices by this amount, your gross margin would increase by this, which would have this impact on your bottom line. But this is how many clients you could afford to lose, or customers you could afford to lose before you're any worse off if you raise the client. That data, that information is not readily available. And so the tool makers are saying, if you pay us X number of dollars a month, we will give you this functionality. And then as a result of having this functionality, you'll be able to have strategic conversations with your clients and charge them a pile of money, because 70 to 80% of them are screaming out for advisory services. Now, I know 70 or 80% aren't screaming out for advisory services. The data that I see says that 80% of clients are doing less than $1 million a year in revenue and have a net profit margin of about 3.5% to 6%. There's not enough money to pay any more than a couple of grand for advisory services. So now there are certainly some clients who are looking for assistance, but they're not. I would suggest they're not rushing at the average accountant who now says, I have a tool that enables us to have a strategic conversation. And from that, we'll do a strategic budget. Now, and what happens is the word strategy is misunderstood. Strategy is about the choices you make in order to achieve a competitive advantage. I mean, that's what business competitive strategy is all about. It's unfortunately, as Roger Martin says, it's usually typically paired with the word planning to form strategic planning. But planning and strategic planning are two different things. Strategic planning is developing a strategy that will achieve an aspirational goal, and then developing a plan of action that you will implement in order to work towards that goal. And so that is a forward-looking thing.
Yep.
But the strategy piece is quite separate from the planning piece. Now, the tool makers say, all you got to do is click this button and it will project out a plan for you. And so people say, oh, that's only going to take me a few minutes and I'll be able to charge $300 or something for this report. And so the speed of preparation becomes the reason for investing in the tool. And invariably, it's just a linear extrapolation, or at least an extrapolation of what went before. Now, we know from COVID and so on, and it's not just COVID. I have done in my career hundreds of cash flow projections, and with the exception of those that we would review and roll over monthly, they will never, ever, ever hit the target. We never actually projected the ending outcome. Now, when you roll it over quarterly, you get to the outcome because it's just the proximity of time. But that will enable you to be able to identify what your peak debts are and be able to do something in advance of that situation. So when the tool makers say that we'll give you this ability to create an advisory business, I would contest that. I would say that you can certainly add some value to your clients. And I think if you complement that by spending time explaining to them, what their financials mean, the difference between profit and cash flow and so on, then, that is of value. Ben, one of the things I used to do with my clients was I'd get there when I was doing a performance review with them. We'd look at the income statement and I'd look at the balance sheet separately. But we ran this through our own software and the 4 ways to grow a business and so on. But when I got the P&L and I'd sit it down in front of them, and they'd understand what the gross profit margin is, and then I'd draw a line through the words less expenses, which is on the P&L. I'd say less the cost of resources used to produce your gross margin. Now, just that phrase changes the perspective, because instead of these things becoming expenses, i.e. bad things, they reflect the resources that you've used to create your revenue and therefore your gross margin. And so it gets you to do a return on expense analysis, gets you to start thinking, what are we getting for what we're paying for this thing? And that gets you to start looking at how you're utilizing your team members, their productivity, what your insurances are covering you, what they're not covering you for. Is there another way of doing it? You can go through all of those things. And then at the bottom of the P&L, there would be a blank line. Intentionally, I had a blank line there. And I would say what we need to put in there is the less the cost of the cost of the transactions that didn't happen, the things that you missed as a result of a customer loss or the result of a bad referral to a customer. Thinking about the cost of the lost opportunity. And when people start thinking about that, they start thinking about what proactive things can I be doing. Now, Ben, I can honestly tell you that conversation will have people walking out of your office thinking, wow, I have never thought of my business like that before. And that you didn't need a tool, you didn't need, a fancy dashboard in order to do that. I'm not saying the dashboard will get in the way of that,
Yep.
But I'm saying that conversation is what gets people really thinking.
Yeah, yep. And so is your comparison then the tool makers, let's say, show the numbers in a different way than the software does. Like let's say you're seeing your monthly sales versus budget versus actual, and you got cool graphs, and maybe clients might get a bit more engaged with that. That's kind of one thing, but the bit that takes it to the next level is that interpretation, the conversation with the clients about, well, hang on, if we did this, that, and the other thing, here's the impact it would have financially. You're saying that's where the conversation needs to be?
I think the conversation needs to get to that point.
Yep.
I think I don't have any argument about saying this is what we budgeted and this is what actually happened.
Yep.
What we have to be careful of, though, is just saying, oh, there's a reason for that, and it was outside of my control.
Yeah, okay. Yep. Which
that it becomes very easy for people to blame circumstances beyond their control. Yep. Because, Ben, at the end of the day, the only thing that a business person cannot control is how much a customer will buy from them at the price they offer. Mm-hmm. Everything else comes within the management of the business. For example, I would say salaries and wages.
Yep.
Now you might say, well, we can't control them because it's mandated by awards or whatever. But what you do to promote the productivity of the people who are paid the salaries and wages will determine the payoff you get from them.
Yep.
Your choice of advertising agents, your choice of location will influence your rent. All of those things are things over which you have control. What you don't have control is the customer decision to buy or not buy.
Yep.
At the price you offer.
Yeah.
That's why Peter Drucker says there are only two things that are important in business: marketing and innovation.
Yep.
That's what he said. He said everything else is a cost center. They're the only two profit centers.
Yeah. It's a bit of a long journey to get to that, but yeah, okay.
Well, what he's saying is profit in Drucker's words, and it gets fairly sophisticated, but in Drucker's words, profit is giving you return on the cost of capital. It's giving you a return on risk. It's providing you with funds to finance your growth, and there will be a super profit, but that will only be transitory because the 5 forces of competition that have been well documented by Michael Porter ultimately will drive that profit away.
Yep.
And so that's where strategy comes in, because strategy is what gives you the chance, not the guarantee, but the chance of creating a competitive advantage. And to use Warren Buffett's terminology, to build a moat around that competitive advantage to defend it.
Yep.
Now, most businesses, if they have a moat at all, it's transitory. It's very difficult, particularly for the smaller business that you and I would be dealing with. But nonetheless, the purpose of strategy is not to guarantee results. It's to increase or reduce the likelihood that you won't get results.
Yeah. Yep. Oh, there you go. All righty. Well, hey, we've covered a lot in our conversations today. And every time I catch up with you, I enjoy talking about the different aspects of what each of us are doing. One thing I want to sort of ask, you've mentioned a few names like, Michael Gerber, Ron Baker. So I've made a few notes of those. Is there any other, people or thought leaders in the profession that you'd recommend people keep an ear out for, in or outside of the profession, by the way? Because I don't think accounting in itself knows everything there is to know.
Well, I would mention Paul Dunn because, I think Paul is really quite an extraordinary guy. But in terms of practical type people, I would say, I think anybody who's serious about having strategic conversations needs to realize that to get to that level, there are a couple of things they're going to have to consider. One is that that I think the only way to create a robust business advisory business that is a strategic advisory is to create a separate entity. I don't think it can be done within the business model of an accounting practice.
Yeah, wow.
Okay, that's the first thing.
That's huge.
Well, I think and the reason for that, Ben, is for many practices, and yours might be an exception, and there could well be others. For many practices, the culture of the organization does not lend itself to providing advice, profit improvement type of work. For starters, I'm talking about fees that would be a minimum of 30 to 50,000. It's not something that you could do for a $5,000 client, and you won't be able to create much value for charging someone $5,000 to do a strategic plan. All you can do is press a button. So you have to do more than that. So therefore you need to study, and you need to, and there are lots of sources, but the seminal work is Michael Porter's work on strategy. There's Blue Ocean strategy. There's Clayton Christensen's work on disruptive strategy. I think the best work that's ever been done on developing a strategic plan is work by Roger Martin, and I can give you, I can provide you with all of these references for people. There's so much stuff. I mean, when I look at my library, I would have hundreds of books that I have read on various things involving psychology, things like, Kahneman's book on thinking fast and slow, and prospect theory. I mean, there are a lot of things that I'd like to say come to mind. If they had come to mind, I'd be able to mention them. But
that was heaps.
Carol Dweck's work on mindsets and so on, that's critically important. There's so much, Ben, that it took people 5 years plus several years of experience to become what you might call a good, capable, confident accountant. It'll take that long to be a good, competent, capable business advisor. To help people run a better business. It's just not something, you can't go to a 5-day course and spend $695 and expect to come out and do anything much more than something that's pretty superficial. And I'm not saying it's not of some value. But
fantastic. All right. Well, thanks again, Ric. I really appreciated our time together, and I'm sure our listeners have also taken away plenty of things. So thanks again, mate. And I hope down the track we'll get you back on the podcast again. And actually, would we be able to keep posted on your book that you're writing as well? So I think that's
well, if I ever get to finish it, I'm doing too much driving around and skiing to get it done. But maybe I will.
Fantastic. All right. Well, thanks again, Ric, and we'll chat soon.
Okay. Thank you, Ben.
Cheers.